Well, hello, everybody. My name is Brian Brady. In the old days, if you Googled me, Google used to call me America's #1 mortgage broker, but I focus a lot of my attention now on strictly VA loans in California and Florida. And along with my wife, Deborah Brady, we originate residential and commercial mortgages in both states. So today we're going to be talking about strictly VA and FHA assumptions, because we think that's going to be a part of the market moving forward. As many of you know, it seems like the market has shifted in the past 2 weeks. Interest rates have spiked, and because of the interest rate spike, we're finding that the old listings that had 14 offers are now getting 2 offers, and the ones that are a tad overpriced but still could drag 1 or 2 offers in aren't getting offers at all. And so I just read a stat that said that 50% of the buyers in the last 2 weeks have decided to drop out of the market because either they couldn't get the house they want because mortgage rates have gone up and made it unaffordable for them, or they think prices are going to be coming down. So I'm going to approach today, and we're going to talk about what a VA or FHA assumption is and how you can initiate it. But more importantly, we're going to talk about how it can benefit you as a buyer's agent or a listing agent. So we'll get going. The first thing I'd suggest to you is, why listen to me? Well, I've been in the mortgage business since 1996, and while a lot of people have come from different walks of life, my wife and I have literally spent whatever that is, 25 or 26 years doing mortgage financing. So we have a pretty good idea. We've seen all sorts of goofy loan programs out there, and we've seen all sorts of goofy ups and downs in the market. And when I saw what happened recently, I immediately started thinking of assumptions. I'm also a licensed real estate broker in California, Alabama, and Florida. So I understand that side of the business. I understand the contracts. And while I don't know everything, I can pretty much tell you how you might have to write something up. I've been a commercial mortgage broker since 2010, and with my wife, Deborah, we work in residential loans. Most of our business is purchase business, and we consistently close $30 million a year working with you, real estate agents. So let's talk about what VA or FHA assumptions are. The cool thing about a VA or FHA mortgage is they don't have what's called a due on sale clause. Conventional loans, when you sell the property, the mortgage is due. VA and FHA loans are assumable. So what's that mean? It means that the buyer can, quote, take over the payments of the seller. Okay, fabulous. Sounds like a great deal. But naturally, in today's market, the mortgage balance is going to be less than the actual purchase price. And we're going to show you how, whether you're working with a buyer who has a high down payment, or if you're trying to sell a property and retain price and you're working with a buyer who's got a healthy down payment, that you can still get your price and they can still get their payment and everybody can be happy. So let's talk about, I'm going to walk you through kind of a scenario of how something like this might work. Let's say that Sammy the seller wants to list a $500,000 home, and he has a $400,000 FHA mortgage balance. He refinanced it last summer to 2 3/4, and his principal and interest plus his mortgage insurance premium, his FHA mortgage insurance premium is $1,933. For this scenario, I'm not including taxes and insurance. So that's the payment he's got without his taxes and insurance. Betty, the buyer, wants to buy this home, and she's got some money. She has 20% down, but the $500,000 is now above her budget because interest rates have spiked. She originally started shopping 6 weeks ago and wanted a principal and interest payment of less than $2,200. And she was 2 months ago, 3 months ago out there making offers and getting beat out. And because of the spike in interest rates, now stuff's sitting on the market. But if she were to snag Sammy's home at $500,000 and with a $400,000 loan, her principal and interest amount would be $23.98. It's almost $200 above what she budgeted. So her agent says to her, well, you know, houses are sitting on the market. Let's offer $470,000 down with a $100,000 down payment. Now you can buy the home with a $370,000 loan at 6%, and your payment will be $22.18. It's right in your budget. Great. Sounds like a great deal for Betty, the buyer. Problem is, Sammy, the seller, doesn't want to drop his price. He wants that $500,000. Now, you may be Larry, the listing agent, and you may say, well, I have to have this, quote, hard conversation with Sammy that the market has shifted. And you may very well have to do that eventually. But before you do that, and if you are Larry, the listing agent, I might suggest to you, because Sammy's got an FHA loan on his property, that he can offer Betty an FHA mortgage assumption. This way, Betty can apply for and get approved for Sammy's old loan, have a payment of $1933, which is well below her budget, and Sammy gets the full price. So let's say that Sammy, Larry, the listing agent, advised Sammy to counter at full price, offering the FHA mortgage assumption. What happens next? Well, here's how FHA mortgage assumptions are done. Betty would then have to contact Sammy's current lender. Let's assume it's with ABC Mortgage Company. And she actually applies for an assumption. Now, this is where it's going to get kind of goofy in nowadays. Most lenders probably haven't had to deal with this in 12 years. They have a department for it. It's probably small. It's probably like one person. So they probably won't know what they're doing next month. But I believe if this market stays and interest rates stay the same or go up, we're going to see more of these happen, and they'll eventually have to start building those departments up. If you can imagine going back 12 years when the short sales were happening, the lenders were caught blindsided and they weren't up to speed. I think we're going to have the same problem when we're talking about assumptions. So you're going to have to be a little bit persistent. But they contact the current lender and apply for an assumption. When she applies for the assumption, she's submitting a normal loan application package with her income and asset documents. And she's actually applying for a $400,000 assumption instead of a loan application, with coming in with $100,000 down. Two things to be aware of here. If the current lender is not an FHA approved underwriter, you could run into a problem. They can, however, refer it back to the originating lender. Let's call that, Caliber Mortgage. And Caliber sold the loan to ABC Mortgage. And Caliber can underwrite the assumption. I'm using the word assumption because that's what it is, but it really does feel like a normal loan application. And in one respect, there's certain legal guidelines they have to follow, which make it more predictable. So the current lender, after they get the assumption package, the assumption application package, they're allowed to charge a reasonable processing fee up to $900 plus any third-party costs. Obviously, they're going to pull Betty's credit, and they may or may not want an appraisal. They don't always have to ask for that, but if they decide they want that, they can do it. Here's the key point. If they are an FHA approved lender or servicer, they have to reply within 14 days. So the underwriting time by law has to be 14 days. Once they approve Betty for the loan assumption, the lender's going to prepare loan closing documents. There's actually an assumption form that they use. It's just one extra form to the loan closing documents, and it closes just like a normal real estate transaction. They have a closing department. They'll contact the escrow company, or if you're in Florida, the title company, and they'll issue the note and the deed of trust, which in Florida they call a mortgage, and the assumption paperwork. And then Betty's required to close the transaction by paying the difference of $100,000. So instead of a down payment, we would call it, paying the difference. That money's credited to Sammy and it's paid out right after closing. So it's relatively simple. Like I said, I believe in the beginning, it's going to be a little bit onerous. And I'm here to tell you that we, both, Deborah and I, are happy to help you with these things. And I'll tell you why at the end. So Sammy sold this thing with an FHA assumption. Does he have risk? Well, in the old days, prior to 1989, Sammy did have risk because VA, the assumptions did not have to be underwritten. Anybody could just assume an FHA or VA loan just based on Sammy approving it. But after 1989, they changed the rules. And so most every loan you see out there now is going to require underwriting for the assumption. And Sammy then is released from full liability of the loan. He could get a new FHA loan if he wanted to, and it proceeds just like a normal sale. Okay, so what about VA? VA loans are assumable as well. They're almost similar, but there's a couple of little wrinkles to it. So let's use Victor the veteran and make him the seller. Same thing, he lists a $500,000 loan with a $400,000 VA mortgage balance. Last year, he refinanced that loan to 2 3/4, and his principal and interest, and the cool thing about VA loans is there's no mortgage insurance, is only $1,633. That makes it very valuable. Betty again sees the jump. She wants to put her 20% down. And wow, this VA deal seems even better. So Betty offers the low offer. Larry, the listing agent, comes in and counters at full price with an assumption, saving Victor $30,000. Well, what happens after acceptance? Same exact thing. Betty contacts Victor's current lender and she makes an assumption application with credit and income documents. The current lender can underwrite the file, and if they are a certain level approved VA lender, they can underwrite the file themselves. They're required to respond in 14 days. Or if they're not, they can send the file to the VA to underwrite it. They only have 7 days to send it to the VA, and the VA will underwrite the file, and they are required to respond within 14 days. So with VA, the only difference is the assumption could take 21 days. The current lender can charge a processing fee up to $300 plus third-party costs. And the trick with the VA is they actually, when they're closing the new transaction, Betty would also be subject to a 5% VA assumption fee, which is paid at closing, and that's paid directly to the VA. Like I said, it closes like a normal real estate transaction, but it has assumption paperwork with the new note, mortgage or deed of trust, and so forth. Does Victor have risk? Well, yes. If Betty is not VA eligible, she actually could assume a VA loan. But two things happen. Victor not only loses his VA entitlement, and that's important because now Victor can't go out and use his VA loan, or he has a much reduced entitlement until Betty pays off the loan, unless Betty has her own VA eligibility or entitlement. The other problem is if Betty is not doesn't have VA eligibility, Victor might be liable for that original loan for up to 5 years, meaning if Betty makes late payments, it could hurt Victor's credit, unless a full VA assumption with Betty's VA eligibility is used. That's the only way that Victor can be released from liability. So if Betty does have VA eligibility, whether she is a veteran or a widow of a veteran, she needs to submit her certificate of eligibility with the assumption loan application. Nowadays, the lender just pulls her VA eligibility off the website. So just explain, you don't have to be a veteran to assume a VA loan, but it becomes risky for the veteran seller. And it's likely that they wouldn't want to do it because it doesn't release them from liability of the original loan. and it ties up their VA entitlement, so they can't use their full VA loan again. Let me stop here before we go into some other creative stuff and answer any questions you might have. If anybody has any questions so far, why don't we shoot?
Hey, Brian, I've got a quick question for you.
Sure.
I'm interested in finding out if this applies to conventional. I've got a pre-approved buyer who has, like, gosh, 3 pre-approvals. He's gone through different people. He's leveraging now against his own investments. So he moved some investment accounts over to Schwab, and now they're trying to have us work with Rocket Mortgage. Anyway, this sounds like it could be doable, but I'm wondering when it comes to a conventional loan, if it's anything that's applicable.
So conventional loans have a due on sale clause, and they are not assumable. And I'm talking about, I should qualify that, Fannie Freddie conventional loans, right?
Right.
They are not assumable. You can wrap them. I'm not going to talk about wraps today because I realize that that's another rabbit hole. But is this Crystal?
Yes.
Yeah. Okay. So Crystal, what you can do is if he looks for a property that has a VA or FHA loan, that might be an option for him to do. So what's the price point this buyer's looking at?
Well, we started shopping at around 700,000. He's gotten 2 pre-approvals up to 1.5.
Okay.
He'd like to stay close to 879, or at least that's what Rocket came back with yesterday on his pre-approval with like a full breakdown.
Mhm.
We're going to revisit budget today because, again, like you're talking about, the market is shifting. He's very specific about what he wants. He has affection for 2 communities that I've been trying to farm but have not had great success with. And there's a listing in one of them that I think is overpriced. It's been on market for quite some time. So I'm waiting to hear back from that listing agent to see what the seller's position is and, you know, if there's a way that we can make it work. But
Sure. Well, let's take that property for example. If you look in Realtor's Property Resource, I use RPR a lot, and
yeah,
everybody here everybody here has access to RPR if you are a member of National Association of Realtors, which I think we all are. You'll be able to see the loan information on there as well. Or if you email Deborah and say, can you pull a title report on it? We can tell you if there's a VA or FHA loan on there. Now, and it sounds like you guys got a bunch of money to put down too, Crystal.
yeah, things got really awkward because he's a 24-year-old investment banker. Honestly, this whole thing, I moved him here as a rental 7 months ago, just as a favor, helped him get into a lease, and now he's a buyer. And because he's so financially well versed, he's trying to see what he can do. He was thinking about getting a hard money loan. I advised against that because obviously he's got funds that he can figure out how to work with. But he wanted to get a loan for about, I don't know, 7 months between now and January. In January, he gets a $250,000 bonus that is already in writing. He knows is coming. So he wanted to get like a bridge loan of some sort and talk to his financial advisor. He moved all of everything over to Schwab. And then he told me this morning, he sent me a photo and it says now he's able to borrow, I guess, against his own money.
Yeah.
And it's a line of 266,000. So
Okay,
I mean,
cool.
I have no idea what he's going to want to put down as a down payment, but if it secures what he loves, then great. It's just that I have no idea how I'm going to approach this listing agent conversation because this is the only property, like he really, really likes this one.
Okay.
It's just the only one that's available and they're not popping up at all.
Okay. So here's a suggestion to you. Deborah put what is the price point of the property he likes?
I think that it's listed close to 1.6, but obviously he doesn't want to spend even close to that. So I was thinking about a million ideas. I already obviously wanted to attend this and learn about what we had already discussed, but this could be beneficial in other ways now that we're looking at different things, you know?
Okay. So if there's a VA or FHA loan on that property, and by the way, there very well could be. Someone could have bought that property 10 years ago with a $700,000 VA loan because
Right.
10 years ago, the loan limits were that high and then they dropped and came back. Pay attention to the next segment I'm going to talk about where the seller can carry back a second mortgage. Any other questions up to this point from anybody else?
Brian, this is Janae. I had a quick question. The first example you gave with the FHA loans, and you said that the lender has to be, let me look at my notes, hold on. Lender has to be an FHA approved underwriter, or it could be a problem. And then you said something else and I didn't hear that right after
Okay.
that.
Yeah, that's a good question. So in the secondary mortgage market, lots of times servicers will buy loans and originating lenders will sell loans. You guys all know that. Your loans have been sold on your house, or your clients are always like, they sold my loan the third time. Sometimes an FHA loan winds up with a servicer who is not, does not have what we call in the mortgage business an FHA full eagle. That means they're a full, they're a fully approved FHA lender as well. If they're just an FHA approved servicer, they may not have what we call a direct endorsement underwriter on staff. Only the direct endorsement underwriter can underwrite the assumption. So what would happen then is they'd say, oh no, we can't do assumptions. Well, that's not true. They can do an assumption, and I guarantee you that their mortgage department won't know that. They'll be trained to just say no. They're allowed to kick that back to the originating lender. So let's assume that PennyMac underwrote the original FHA loan and sold it to ABC Mortgage, who is an FHA approved servicer, but they don't have we call them a full eagle on staff. The full eagle means that they have full authority to act in the FHA's interest. So they would say, you know, ABC Mortgage would say to you, sorry, Janae, we don't do assumptions. We don't allow them. Well, they're not allowed to say that because FHA loans are assumable, and they do have to make a credit decision if they're a servicer. They have the ability to kick the underwriting decision back to PennyMac, who is the originating lender, and let the PennyMac underwriter make the decision on the assumption. And they're actually bound by that. So when they bought the loan from PennyMac, there's language within the paperwork that says, we agree to consider via FHA assumptions. And if we're not able to do it, we agree to work with the originating lender to grant the assumption. When a company buys a loan, you guys know this if you were around 12 years ago, mortgage companies are horrible, horrible people. And so, you know, they don't follow the law. They just say no, right? The servicers will say no. And you have to kind of push back on them and say, you're not allowed to say no. When you bought the loan, you agreed to consider assumptions because it's an FHA loan. And if you're not equipped to handle that, then you have to figure it out. And if you call me, I can track it down and say, you know, I can get on the phone with ABC Mortgage and say, from whom did you buy this loan? Oh, we bought it from PennyMac. You're required by law to kick it back to PennyMac, and they have to underwrite the assumption for you. And you're bound by their decision because that's the deal you made when you bought the loan. Did that answer the question, Janae?
Perfect, yes.
Okay, great. Any other questions at this point? Okay, guys, because I'm recording and have this, I'm not seeing everybody, so I'm going to give it 10 or 15 seconds just in case there's any other questions of silence. Okay, so now I want to talk to you about some more creative stuff you can do. What if Betty only has a 10% down payment of $50,000? And Larry or Victor, you know, still want to sell their property for $500,000 with a $400,000 VA or FHA loan. Well, Larry or Victor can actually carry back a second mortgage at any terms agreed upon for the difference. Now, they can't go to 100%. In both cases, Betty is going to have to come in with some money. So, it's not both. FHA is very clear that Betty would have to come in with a minimum of 3.5% in the total deal. VA is not clear. They say that theirs is that the assuming buyer has to come in with some money. So Larry or Victor cannot carry back the full $100,000. But in this scenario, I'm going to say, okay, she has 10% down, and Larry or Victor can carry back a second mortgage. Why would they do that? Well, maybe they don't need the full $100,000, and they wouldn't mind owning a debt instrument that paid them, say, 6, 7, or 8%. I'm going to walk you through the scenario, and then we'll talk about whether it's a good idea or not. I just want to get you equipped, because I think you may, I mean, if this market turns like I think it could, for a period of time, you might be trying to get really creative to make deals happen. So I'll walk you through this. Larry or Victor will carry back a second mortgage. They're going to let Betty assume the first mortgage, and then they're going to be in a second position lien. In that case, they would only get $50,000 at the sale, plus they would get a $50,000 note and deed of trust or mortgage, depending upon which state you're in, California or Florida, for $50,000. Larry or Victor now have all the rights of a lien holder, a second lien holder, and they can sell those rights with the note and deed of trust on the secondary market. So let me show you what that deal looks like, and then we'll see if it makes sense. All right, Sammy the seller lists this same $500,000 home with a $400,000 FHA mortgage balance. They're sitting on a 2 3/4 loan. His payment right now is $1,933. Betty wants to buy the home. Again, the jump in interest rates made it unaffordable. She wants to put down 10%, but she wanted her P&I payment to be less than $2,500. The spike in interest rates would have her at $2,900. Well, Betty decides, okay, the only way I can buy this is now to offer $430,000 with a $50,000 down payment. That's the only way she can get her payment down to $2,478. That's clearly not going to work for Sammy. But let's assume that Sammy is stubborn, and you might know, hey, he's going to have to reduce his price, but you don't want to have that hard conversation with him until you look at this option. So Larry, the listing agent, might advise Sammy to counter at full price and offer Betty an FHA mortgage assumption at that low 2 3/4, plus a seller carried second mortgage for $50,000 at 8% interest only with a monthly payment of $333. This is a great deal for Betty the buyer, because Betty the buyer would literally save over $300 a month. The $1,933 original payment and the $333 second mortgage would be well below the $2,500 a month budget she had. So she applies for it, gets approved for the assumption. Now here's the trick. When she applies for the assumption, you have to include that she's going to, that Sammy's going to grant her a second mortgage of $50,000 at 8%. They have to use that $333 a month in the underwriting decision. By the way, here's another caution. I don't know about Florida, but I do know for California, for owner-occupied properties, Sammy has to offer at least a 5-year term for that second mortgage. He's not allowed to offer a 1-year term in hopes that she can refinance later. He has to offer her at least 5 years to be compliant with the law, and it won't get approved if it's not. Anyway, so she gets approved for the assumption, she saves the money, and Sammy gets $50,000 at closing, plus he gets a $50,000 second mortgage. What's the risk for Sammy? Well, there's a little bit of risk for Sammy. He doesn't get all his money at once. That sucks. He does, however, get a $50,000 lien, and he has the right to foreclose if she doesn't make the payments. And he could charge a pretty good interest rate and get a pretty good return on his investment. So why might Sammy do this? Well, you know, maybe he doesn't need all the money right away, and maybe he'd be happy carrying back a second mortgage and having a $50,000 investment that pays him 8%. So that's another creative way to do that. How tricky is it? It's really not tricky. You can actually put all this stuff on offer paperwork in California. If you're using a residential purchase agreement, you'll actually see that there's a spot in there for owner carries. And if you ever come across one of these, you can call me and I'll walk you through how to do it. It just would help if we're both looking at the RPA. In the Florida as is contract, you would have to do it in the very comment section. I think it's on page 11. Again, I'm not looking at the contract, but if you're a Florida agent and you wanted to either offer with an assumption, make an offer where the buyer assumes the loan, or an offer with an assumption and a carryback, you can give me a call. When we both have the contract up, I'll show you how to fill that out. So let me stop there before I talk about some advertising ideas for you and some practical applications, because that last one can be a little tricky. What questions do we have about the seller carryback in conjunction with the assumption?
Hey, Brian, I put a question in the chat. What if there is no monthly payment required for the seller carryback, only a balloon payment in, say, 5 years? Then that monthly payment amount wouldn't necessarily need to be used in calculating the eligibility for the assumption. Is that correct?
No, but I like how you're thinking, TJ. Like, that's how you get deals done, right? So you think outside the box. So the problem with that is FHA has a standard where it's not allowed. Like, you would think about that for a family member. This can't work between family members, by the way, because that's a whole different animal for FHA and VA, because that's a non-arm's length transaction. This only works for arm's length transactions, and both FHA and VA's requirement is that the second mortgage have they call them reasonable and customary market terms, meaning, you can't charge 14% for the second mortgage, and you can't charge. It's subjective, but the general rule of thumb is you can't charge less than what the first mortgage is. So if there's a 2 3/4 mortgage, the underwriter is going to say they want that second mortgage to be charging at least 2 3/4, and that there has to be some sort of a payment. And it can be interest only. It doesn't have to be fully amortizing, but they do have to have some skin in the game every month. Did that answer the question, TJ?
It did, yeah, thanks. What if it was taken as an equity share?
Okay, that's a different animal. That's a much different animal, and I don't know the answer to that, because I don't, and I think that even the underwriters today wouldn't know how to deal with it. So I think the reason I'm saying that is because I don't think underwriters have processed assumptions in a long time. So I think it's going to be new for everybody. Equity sharing is a different animal. I don't know if you can assume the mortgage, but I think that's worthy to look into, and I'll do that and talk to you next week about it.
Sounds good. Thank you.
Cool. Any other questions about the seller carrybacks at this point? Again, I'm going to go with the 10-second rule and just be quiet for 10. Okay. Yeah.
Hey, Brian, another quick question. I've got another buyer who's pre-approved with 100% financing through Navy Fed.
Okay.
They are struggling a little bit.
Over here at
maybe everybody else can, if you're talking, put it on mute. Go ahead, Crystal.
So he's pre-approved for like 325. We found a property for 328, and because Navy Fed is doing 100% financing, he's not going to have a down payment, but we're going to send like a couple $1,000 for an EMD to show sincerity, right? Like, no other offers, looks like we could take it. Problem is, I'm wondering if I should be looking for some kind of loan assumption for him as well, or if that's a possibility. Do you think, because that's a conventional as well, that it's something that I could look at? Like, if I just send over a couple addresses, because I'm not sure how to look up exactly where their mortgage is and what kind of mortgage it is, if it's assumable.
Okay, so I'm gonna answer your question, Crystal, and then I'm gonna talk pragmatically to you. And I'm going to talk pragmatically first. Don't waste your time doing that. Now, but let me tell you why it's a good question, because this market isn't such yet for that opportunity. And that's actually a great question. So the question is, she's got a guy approved for conventional. Should she be out there looking for an assumption opportunity for him? And the answer to that is, in the last year or two, all the low rate mortgages were originated at least a year ago, and people are going to have equity. And it's unlikely that a seller is going to own or carry back the full down payment, although they could do that, Crystal. So, but it's unlikely in this market that an owner is going to do that. So pragmatically, it doesn't make sense for you to do. However, let's assume we go, and I don't think this is going to happen, but let's assume we have a 20% drop in values over the next 2 years. And that would be a lot. You may have people whose equity is now close to being underwater. And I'll give you an example. If he's with Navy Fed, there's a better than average chance that he or a family member has VA eligibility. And now you might want to go out there looking for a veteran who might be either close to or underwater, meaning they actually, that $500,000 home, let's say values drop 20% in the next 18 months. And now this guy he didn't sell his home today, he waited, and now he's got a home that's worth $400,000 with a $400,000 VA loan on it. Well, why would he sell, right? Well, he doesn't want to walk away. He doesn't want to, and if he sells it and has to come in with money, he's going to hate that. Maybe he can't rent it. You're the hero at this point, Crystal, because you have a buyer that who's, and especially if he has VA eligibility, can do a full VA assumption and just take over the payment. And Victor, the veteran, right, at this point is now in trouble because let's say he's getting transferred if he's a civilian now, or if he's active duty, he's PCSing out to the East Coast. He can't rent the property for what he wants, and he can't sell the property for the price he wants. And your buyer is able to walk in and take over his payments. Like that's the best way to put it.
So I see this being a good scenario in the future when after the market continues to shift, and if it goes ahead and shifts that far. But it's a good strategy. Thank you so much. This is excellent.
Yeah, thank you guys for being here. You guys like, I'm laughing because I'm looking at the 12 or so people that are here going, oh, these are the people that are going to be doing deals. And because I think by the time this hits the market, and we may not see this stuff for 6 or 8 months, people trying to look at this, no one's going to know what to do, and you guys will have already done one. Okay, I'm going to give another 10 seconds to see if there's other questions about assumptions with a carryback. Okay, let me tell you guys the opportunities here. If you are a listing agent and your client has a VA or FHA loan on that, it really makes sense for you to educate them about the opportunity of assumptions. And after you get the listing agreement, because I don't ever want to come in and confuse people, after you get your listing agreement, if you say, I'll have you talk to someone who understands that, I'm happy to do a Zoom call with one of your clients and explain how, we can walk through this basic presentation with them. And by the way, when I'm finished the presentation, I will email you all a copy of this PowerPoint. So you can go in there and say, listen, you guys should advertise that you have a 2 3/4 VA loan. I actually saw a couple listings in San Diego that are advertising this. I'll give you guys just a little bit of caution on it. It's being advertised incorrectly. Why should you do it? Because you can price at the high end of the range. Let's say that you think the value of that $500,000 property is really $470, and Victor is convinced that he can get 500. You're going to have those problems coming up soon too. You're able to say, hey, Victor, look, it's cool to offer at 500,000, but you've got a really valuable commodity here attached to your listing, and that is a low interest rate assumable loan. And if you offer that, you might get the price you want. So it can retain the price for the seller. But when you advertise it in the MLS or in public, if you advertise either the rate or the payment, you must include the APR. I don't know what that APR is. I don't know what that APR has to be. You could use the original APR, or you could call me and I can calculate what the APR is. As long as you're within 0.2%, you're legally compliant. I do know that the ones that are being listed right now and advertised in the marketing remarks are not compliant, and therefore, you subject yourself to a fine. Will they do it? I don't know. I don't know if the Department of Real Estate will do it, but you guys are in the know now. If your client wants to list the property, you want to advertise that he's got a 2 3/4 VA loan, call me and I'll get you an APR that'll keep you out of trouble. If they have a VA loan, I strongly recommend that the VA assumption only be offered to VA eligible buyers with X down payment. Like that's what I would use in the language, unless he's willing to entertain a seller carryback. And the reason I say VA eligible buyers is because I believe that there's a whole lot of risk if a veteran allows a non-veteran to assume the loan. They've got that contingent liability of 5 years, and their VA eligibility is tied up. But you should make it very clear to your veteran seller that if they sell to someone who has VA eligibility, another veteran or surviving spouse or someone who has VA eligibility, they could get a higher price because they're able to offer a lower mortgage. So I'd be very specific if you're offering an assumption, what the terms would be, like that you're not willing to entertain carrybacks and that they have to have so much for a down payment. I do the same for the FHA, and again, unless the seller's willing to offer a carryback. I'm going to stop there for that because I'm almost finished, but are there questions about advertising your listings? Okay, what should buyers do? Buyers agents should be on the lookout for listings with VA or FHA loans. If you've got a buyer that's got a high down payment and is cash heavy, and he's approved for a conventional loan of $400,000, and he's going to be getting 6%, and he's happy as a clam that he's got money and he can be competitive. If you're on the lookout for VA or FHA loans, you might be able to make an offer and have him assume that $400,000 loan. As a buyer's agent, you can initiate that. There's going to be a long education curve, because I guarantee you most listing agents have no idea most agents have no idea how these things work. They learned them in their continuing ed and forgot about them completely. You guys know better now. So if that's the case, again, I'm happy to get on the phone with you and explain it. But if you've got a cash heavy buyer and you're looking at a property that's say been on the market 14 or 21 days, and again, I'm using that $500,000 number, and you think the thing might have a price reduction soon, or that maybe the guy's stubborn and won't reduce the price, and you happen to look at your title profile, or you go on Realtor Property Source and see that he has a VA or FHA loan, well, go ahead and make an offer with an assumption. And by the way, the rules are different if you're the buyer side. If you've got a non-veteran, it's not your job to educate the listing agent about the contingent liability the veteran might have on the VA loan. It's your job to represent the buyer and get him the best deal. So go ahead and make that offer, and then try to educate the listing agent a little bit about how assumptions work. Will they do it? Probably not this month, probably not next month, but this fall, listing agents might be scrambling to retain price, and you can get a super deal for your buyer while giving the seller the price that they want. So obviously look for seasoned or overpriced listings. And if you have a stubborn seller, this can be a great negotiating tool. Okay, I'm going to finish up the thing here, and then I'll open up to questions. Why don't you know about this? Loan officers hate assumptions because they don't make any money on them. And there's a lot of work. You got to educate people. So if you talk to your favorite loan officer, they'll be like, oh, no, we don't do assumptions, or we don't get involved in that. And that's true, we don't get involved in that. But again, Deborah and I have been in this business for 26 years, and we've been in this business for 26 years because we sometimes do work that we don't get paid for. We made a lot of money in the last 2 years, and you know, I understand that it's not going to be like that forever, but we're long-term players in this business. So if we have to jump on the call with someone and explain to a buyer or a listing agent or even a seller how an assumption works to get the ball rolling for you, pick up the phone and call one of us. We're busy, but we're glad to set aside some time and do a Zoom call or a telephone call to help you get the deal closed. Now, here's the cool thing. Let's say your favorite loan officer works for a, if they're in California, they work for a mortgage broker that's DRE licensed, or a lender that's DRE licensed, or if they're in Florida and they also have their real estate license, because some do, you could, if you decided you wanted to, pay a referral fee to them at closing. Let me tell you how that works. Again, it's your call on it, but let's assume you're getting, let's say the co-brokerage fee is 3% on a $500,000 listing. And the only way to make this deal work is to get this loan officer involved, and you decide you want to pay 0.5% to them, you know, $2,500 of your commission to them. You can, on that side of the transaction, initiate a referral agreement and pay it to the loan officer's licensed real estate brokerage. It's legal, it's compliant, but again, it's your call. Maybe if that's one way you can compensate them. Or a long-term professional mortgage broker will understand that sometimes we work for free and that this is how we gain clients rather than just serving customers. And the point I'm trying to make to you is Deborah and I are happy to help you. Like I said, I'm busy hustling business just like you, but I can't always respond, you know, to something like this in 24 hours. But if you're trying to work with a buyer and explain how assumptions work, or more importantly, if you're listing a property and you want this guy, you want your seller to understand that he's got a very valuable asset, and that if he gets educated on it, he could actually sell for a higher price, I'm happy to jump on a Zoom call to explain it to them. Okay, what questions do we have before we finish up? Okay, I'll give it 5 more seconds. Okay, well, I want to thank every single one of you for coming. You guys are way at the forefront of the industry. You're on that little email list when you registered to learn about webinars. So the next one I'll do is to talk about wraparound mortgages, which is like really out there, but it's pretty cool. And I think it'd be cool for you to learn about them. So I will invite you to that. If you're watching this on YouTube, because we did record it, my phone number is 858-699-4590. Deborah's is 858-228-0617. And you can always get in contact with Deborah at www.bradymortgage.com. Awesome, guys. Go out. Just remember, you can't earn a commission unless you're on a mission. You guys are on a mission today. Take care.
Bye.